Welcome to this explainer. Today, we're diving into Southern Copper Corporation. And honestly, we've got a massive contradiction to unpack. We're looking at one of the world's biggest integrated copper producers, and they are in a wild situation right now. We're talking record-breaking profits colliding head-on with plunging production numbers. It's a total paradox, and we're going to break the whole thing down for you. But real quick before we jump in, just remember, this explainer is for educational and informational purposes only. It's not financial advice, so definitely do your own research or chat with a professional before making any investment moves. All right, let's get into it. Okay, let's start with a seriously staggering number, 40.9%. That is Southern Copper's year-to-date gain as of mid-August 2026. To put that into perspective for you, they are absolutely crushing the S&P 500, which sits at around a 14% return over that same period. I mean, this stock has been on an absolute tear, hitting a market cap of roughly $164 billion. But here's the massive disconnect we need to explore today. How does a stock with a 40.9% gain have almost all of Wall Street screaming sell?
Well, to understand that disconnect, we really need to look at what drives this company. Southern Copper is a subsidiary of the massive mining conglomerate Grupo Mexico. They operate as an integrated producer, meaning they've got mines, smelting, and refining facilities, all heavily concentrated down in Peru and Mexico. But here's the kicker. Their revenue stream, it is completely dominated by copper, making up 73% of their sales. The other 27% comes from byproducts, things like molybdenum, zinc, and silver. And look, when you're this heavily concentrated in one single commodity, the global price of that commodity pretty much dictates your entire reality. And lately, that reality has looked incredibly lucrative. The financial results are, honestly, staggering. For the second quarter of 2026, Southern Copper's net income surged an unbelievable 71.6% year over year. We're talking about a massive $1.67 billion. They also posted a 60% jump in adjusted EBITDA, pushing their margins to a sky-high 66.6%. They just completely blew past consensus earnings estimates, posting $2.01 per share. So, by basically all traditional financial metrics, this company is literally printing money right now. But okay, here is where we hit the core paradox of 2026. For the first half of the year, revenue surged 38.4% to $8.54 billion. Sounds great, right? Yet, actual copper extraction, the literal physical metal they are pulling out of the ground, dropped by 3.8%. For the whole first half of the year, they only produced about 461,000 tons of copper. And actually, it wasn't just copper. Molybdenum and zinc production fell by nearly 7% too. So when asked about these massive financial wins happening at the exact same time output is dropping, management had a pretty interesting response. CFO Raul Jacob credited the results to internal operating excellence alongside sustained global demand for their metals. Now, it's undeniable that the company is managing its operations tightly to maximize those margins. But let's be real, you can't have operating excellence make up for falling production forever without some outside help, right? So why exactly are profits up when they're pulling less metal out of the dirt? It comes down to massive macro surges in commodity prices. For the second quarter, COMEX copper averaged $6.16 per pound, which is a 31% increase. Molybdenum shot up 43%. And silver jumped an unbelievable 118% to over $73 an ounce. So the global commodities boom is essentially masking their operational shortfall. They are selling less product, sure, but they are charging significantly more for it. However, that production problem, it is very real, and the negative trend is continuing. We saw a 3.5% decline in Q2, a 3.8% decline in the first half of the year, and get this, management's own guidance suggests a roughly 5% decline for all of 2026. They're aiming for about 917,000 tons. So what's actually causing this? Well, the main culprit is deteriorating ore grades, specifically at the Cahuajon mine in Peru. Basically, lower ore grades mean you have to dig up and process a whole lot more rock just to get the exact same amount of copper. Just at that one mine alone, these lower grades cost the company 35,000 tons of lost extraction. So how does management plan to actually solve this crisis long term? Well, they've mapped out a recovery timeline. They anticipate production is going to remain mostly flat into 2027, but then they project a ramp up. They're aiming for 970,000 tons in 2028, crossing the 1 million ton mark by 2029, and then aggressively scaling to nearly 1.6 million tons by 2033 or 2034. That is an incredibly ambitious target. If they hit it, it would nearly double their current output. So what's the linchpin holding this entire growth story together? It all rests on one project, Tía María. This is Southern Copper's $1.8 billion flagship copper mine, located in the Arequipa region of Peru. As of mid-2026, it sits at 42% physical completion, and they've already poured nearly $700 million into it. When this finally comes online, which management expects in the second half of 2027, it's projected to add 120,000 tons of annual copper capacity. Simply put, Tía María is absolutely essential if Southern Copper wants to reverse this current production decline. Now, what's truly fascinating is the incredible contradiction happening right now around this specific project. On one hand, institutional investors are practically throwing money at it. In June 2026, Southern Copper did a $1.25 billion bond offering to help fund things, and demand reached $4 billion. It was 3.2 times oversubscribed. But on the other hand, just 2 months prior, in April 2026, Peru's government actually revoked the project's operating permit, ordering a technical reassessment. So despite losing the permit, the company is continuing construction, and the bond market seems totally unfazed by the regulatory risk. It is a massive game of chicken. Let's move on to the Wall Street disconnect and SCCO's bearish consensus. This regulatory turbulence really brings us to a massive disconnect between the stock's current $164 billion market cap and Wall Street sentiment. Retail and bond investors might be buying in, but equity analysts, they're painting a very different picture. With the stock trading up around $194, major banks are practically screaming sell. JP Morgan has a target of $131.50, UBS is at $145, Scotiabank at $140, Barclays initiated at $148. Across the board, you have an average price target implying a dangerous 10 to 15% downside from current levels. In fact, only about 5 to 10% of analysts even have a buy rating on the stock right now. The stock is trading at a price-to-earnings ratio of about 29, which is a huge premium compared to the broader materials sector average of just 15. You know, analysts are so deeply divided mainly because of how you choose to value the business. If you use a discounted cash flow model based purely on their booming earnings, the stock actually looks fairly valued, maybe even slightly undervalued at around $208. But if you run that same model based on free cash flow, it suggests an intrinsic value of just $82, meaning the stock could be drastically overvalued. So why the massive gap? Because while earnings are sky high right now, the actual cash required to run the business and build these massive new mines is incredibly intensive. And yet, despite all these valuation fears and cash flow concerns, Southern Copper is being incredibly generous with its shareholders. They recently increased their quarterly cash dividend by 10% to $1.10 per share, and they executed a stock split. That brings us to this massive number, 99%. That is their current dividend payout ratio. Meaning they are essentially paying out almost every single dollar of their net income directly to shareholders right now in the form of dividends. But hey, before you jump in just for that juicy yield, you've got to weigh those rewards against 5 critical risks we've uncovered in the data. First, the very real production declines driven by lower ore grades. Second, the heavy regulatory uncertainty hanging right over their flagship Tía María project. Third, that massive valuation premium we talked about. Fourth, the sheer cost of their future, a massive $20.5 billion capital spending program over the next decade, which, by the way, is exactly why that free cash flow valuation was so low. And finally, number 5, their heavy operational concentration in just 2 countries, exposing them quite a bit to local political and regulatory shifts. Ultimately, your view on Southern Copper is going to depend heavily on your timeline, your belief in the sustained high price of global commodities, and of course, your personal risk tolerance. They're executing incredibly well on the financial side, but the physical reality of mining is throwing up some huge hurdles, which leaves us with one final, absolutely crucial question for you to consider. Is the copper price boom just masking a long-term production crisis? Thank you so much for joining this explainer. If you found this breakdown helpful, definitely take some time to dive into the sources yourself and keep learning. We'll see you in the next one.